All right. Hello, everyone. Welcome back to our series in which we are covering one chapter at a time, and the book is The Disciplined Trader by Mark Douglas, right? So, this is about developing winning attitudes and human psychology and how it is going to affect in trading environment. So, that's where it basically focused on. So, we have so far already covered chapter number 14. So, last video was about chapter number 14. We have started this series from chapter number 11, I guess, 10 or 11 onwards. So we have made already 2 3 videos, so you can watch it and then you'll come back here, so you'll get, you know better understanding of what we are going to talk about today. Now let me walk you through the content we have covered so far. So yes, basically this book contains introduction. Like, there are four basic units. First one is introduction, and the second one is the nature of the trading environment from a psychological perspective, then building a framework for understanding ourselves. So from this point onwards, we have started this series, why we need to learn how to adapt, and then we covered the dynamics of goal achievement, managing mental energy, and then techniques for effective change. So far we have effecting change. So far we have already covered it, and from today onwards we are going to start the new unit, that is how to become a disciplined trader. Now from here onwards, whatever we have learned in the past, now we are going to, you know see how it is going to affect in the market, in the stock market. So we are going to talk about price movement and the psychology behind it. So again, if you are from the trading background, then it is something very important for you. Even if you are not from the trading background, then also it is related to psychology, which is going to help you one way or another in future for sure. So let's dig in right up. So from we will cover the psychology of price movement today. So let's start. See, basically the stock market is all about, mm, you have to buy at less price and you have to sell at more price, then only the gap will give you the profit, right? That's where you will be earning the money. So that's the basic principle that we all work in. So for that we use different strategy, different indicators and stuff, and we have our own things to do, and we have our own set of rules, and we have to follow discipline. We have to check a lot of things. But yeah, that's the basic idea behind it. You have to buy at low and sell at high, then only you'll get the profit. Simple demand supply thing is related to it, right? Now let's begin with the chapter itself. So as we generally do in the chapter, we go through each word, like we go one word by word, and whenever I feel like there is a need to share something related to it, or whatever the example or anything that comes to my mind, I'll talk about it. Otherwise we'll simply go through it, right? So you can also go through it. And yeah, if there is anything that you want to share, then yeah, comment section is open for you. All right, any suggestion, anything is dearly welcomed. Okay. Now, chapter 15, the psychology of price movement. My objective for this chapter is to break down and analyze the dynamics and psychology of price movement. First, at its most fundamental level, that of the individual trader, then I'll broaden the explaining by examining the behavior of traders collectively as a group. I want to demonstrate that if you understand the psychological forces inherent within traders' actions, you can easily determine what they believe about the future by just observing what they do. Once you know what traders believe about the future, it's not that difficult to anticipate what they are likely to do next under certain circumstances and conditions. Okay, what is really important about this insight is that it will help you to understand the distinction between wishful thinking and the actual potential that exists for the market to move in any given direction. You'll be learning to let the market tell you what to do by understanding the forces behind its behavior, and then learning to differentiate between pure uncontaminated market information and how that information is distorted once it starts doing something to you. The most fundamental component of the markets is traders, right? Keep in mind the traders are the only force that can act on price to make them move. Everything else is secondary. What makes a market? Two traders willing to trade, one wanting to buy and one wanting to sell, who agree on a price, then they make a trade. Okay, what does the last posted price represent? The last posted price is what someone was willing to pay and what someone was willing to sell for at the moment. the two traders agreed on the trade. It reflects an agreement in present value between those traders acting at that price. What is the bid? A trader announcing the price at which he is willing to buy. What is this offer? A trader announcing what is the offer? A trader announcing the price at which he is willing to sell. How to how do traders make money? There are only two ways to play this game to make money: to buy at a price you believe is low related to where you can sell it back at some future point in time, or to sell up at a price you believe is high related to where you can buy it back at some future point in time. Right? So sellers, what they do, they sell at higher prices and they buy at lower prices, so they get the profit. And buyers, what they do, they buy at smaller prices and they sell at higher prices. So one of the same thing, it's just doing the thing in a little bit different way, but the crux is the same only. Right. Now let's take a now let's take a look inside the pit to see what has to happen for prices to move off equilibrium and how this will tell us what traders believe. 98:18, the offer, sellers attempting to sell high. 98:17, equilibrium, the last price. 98:16, the bid, buyers attempting to buy low. Okay. Since the only object to trading is to make money, we can assume that a trader will not knowingly enter into a trade believing he is going to lose. And for a trade to exist, requires true traders who agree on a price. However, from the moment true traders agree to trade, they are both subjecting themselves to market risk. In other words, the next tick is going to make one of them as a winner and the other one as a loser. Since we know that both traders want to win and neither trader wants to lose, we can assume that both traders have completely opposite beliefs about the future value of the contract. So, for two traders to agree on a price and make a trade, they have to have diametrically opposing belief about the future. The buyer believes he is buying low related to where he can sell back at some point in the future, and the seller believes he is selling high related to where he can buy back at some point in the future. If the next tick is going to make one of them a winner and a loser, and one as a loser, we can assume that neither one of them believes he is going to be that loser. If the seller believes the next tick was going to be up, why wouldn't he have waited to sell it higher? The same is true for the buyer. That is the object of the game and the only way to make money. Basically, what we have is a situation where two opposing forces are clashing. Both believe they are right about the future, and only one side can profit at the direct expense of the other. If the last price of a bond future was 99.14, what has to happen for the price to move 99.15? Very simple. Some trader has to be willing bid and pay higher than the last price. This means that the relative to the last posted price, he has to be willing to do the opposite to of buying low. And trader or group of traders willing to buy high or sell low related to the last posted price is very significant for several reasons. First, a trader willing to buy high or sell low instead of buy low or sell high has to have a stronger conviction in his belief in the future value, even if his conviction is out of panic. Second, he is making the last price a bottom. Third, he is aggressively taking the initiative and is making losers out of everyone who sold at the last price and deepened the losses of those who sold lower. Fourth, he is creating price movement that can possibly gather momentum if other traders perceive the new price as low relative to the future. This will also be true for the trader who is paying up to liquidate a position. On the other hand, the seller on the other side of this trade being lured into the market by the attractiveness of the high price at which he can sell. He believes he is getting the edge. He is in fact selling high, but he is not creating moment or much of a possibility for momentum in his direction. He is picking a top and waiting for something to happen, hoping it won't go any higher. Now, what do the actions of the two traders represent about the market is in its collective form? First, this trade tells us that nobody had a strong enough belief in the future value of risk selling it to him at the last price or lower. Second, nobody was aggressive enough to want to enter the market short or liquidate an existing long position by offering to sell it at the last price or lower. A consummated trade at the next higher level creates a a new equilibrium. This new equilibrium makes winner out of all the buyers at the last level and losers of all the sellers at the last level. Okay. All of the losers at the last price level or lower would have to maintain a belief in the future value to stay in their position to demonstrate a conviction in this future value by adding on their position. This is because each new level the price is bid up makes it makes it that much more attractive to them. If they believed it was high at lower levels, at each higher level, it's even a better trade. However, at the same time, each move the market makes against their position invalidates the seller's expectation of future value. Each move clearly demonstrates that the sellers are passive, that the buyers are the aggressors, and that the buyers have a greater potential to move the market in their direction, right? So that is how it is supposed to be done. Now, the fact that buyers are aggressively bidding up the price and paying more and more again tells the observer something. It tells him there aren't enough sellers to meet the buyers demand for a trade at each new price level. If there is a limited supply of sellers, those traders wanting to buy will have to compete among one another for the limited number of sellers available willing to take the other side of the trade. Just observing this price action tells you that at the present moment, the momentum is in favor of the buyers. Prices would not be bid up unless there were few sellers in relation to the buyers. If traders continue to pay more and more, the price gets further away from old sellers. Eventually, their belief in future value will erode, and one by one, the sellers will join the existing pool of buyers competing against one another for the fewer and fewer traders willing to sell. Right now, okay, just give me 1 second. So, there is something that I have to do. All right, so we'll continue in this manner for a little while. Okay, I can turn it on now. There was some family kind of stuff. Now, moving on. Now, what will start to tip the balance to cause the markets to fall back? Hmm. For one thing, all old buyers will eventually take profits. When they do, they will be joining the existing pool of sellers, thereby increasing the number of traders available to sell. If a move gathers enough steam, it can become similar to a frenzied shark feeding. Eventually, price will be driven way out of line with some economic factor other traders perceive as relevant, compelling them to enter the market in the opposite direction. If these new traders enter with enough force, it will likely cause old buyers to panic, adding to the downward momentum. Maybe you can visualize this back and forth action. When there are more sellers than there are buyers to take the other side of the trade, the balance will be tipped. Sellers will then aggressively offer to sell lower than the last price, responding to what they perceive as a limited number of buyers to take the other side of the trade. All price movement is a function of group behavior. The market price flows back and forth like a tug of war between who believe and expect the market to go up and consequently buy, and those that believe the market will go lower and consequently sell. If there is no balance between the two forces, one side will gain dominance over the other as price as prices move further and further away from the weak group. The emotional pain of admitting they are wrong will be direct conflict with their need to avoid losses. Eventually, one by one, they will lose faith in their position and liquidate their trade, adding to the momentum of the dominant force. The prevailing force will continue to dominate until there is a general perception that prices have gone too far and are out of the line with other related factors. The members of the dominant force will have to switch sides to liquidate their position, creating momentum in the opposite direction. As individuals, if we do not have the strength actually to move prices in the direction we would most benefit from, the next best thing is to learn to identify and align ourselves with the side that has established dominance until the balance shifts, and again align ourselves with the side establishing the strength. As prices move back and forth in this tug of war, it creates an ebb and flow that is easily identifiable in price charts or point and figure charts. These charts will show us in graphic terms how the forces interact and counteract. There are visual representation of traders' beliefs in the future and the intensity in which they have been willing to act on those beliefs. If, for example, a market has been making consistently higher highs and higher lows to determine what is likely to happen next, ask yourself the following questions. Very, very, very important. What kind of price action will sustain the buyers? Believe that they can make more money. Okay. When are sellers likely to come into the market in force? When are old buyers likely to take profits? When are old sellers likely to lose faith in their position and bail out? What would have to happen for buyers to lose faith? What would have to happen to draw new buyers into the market? Okay, let me just write it down. Okay, let me simply copy paste because this is important stuff. Okay, there are four questions that we are supposed to ask, right? Okay, that is. Mhm. Just give me 1 second. As I said in the last video also, when I'm noting down things and you feel bored, so you can simply skip next 5 to 10 seconds and I'll be back into the content itself. Right. Okay. hmm Okay. So these are the questions. Let's go through the questions once again. So the scenario over here is why it is showing this. I don't need it. Okay. For example, a market has been making consistently higher highs and higher lows. To determine what is likely to happen next, ask yourself the following questions. So here what we are trying to say is, let's say there is a uptrending market. So when a market is making higher highs and higher lows, that simply means my market is going in the above direction. I hope you all are getting it right. Let me just draw it for you now. So let's say this is how market is moving. So what is happening over here? This is one high. This is another high. This is another high. This is one low. This is another low of this thing, right? This is another low. And this is another low. So what is happening over here? They are saying that the market is making higher highs and higher lows. That means the high is more than or higher than the last high. That means it is in the uptrend. And higher lows, that means the low is comparatively higher than the last low. That means market is simply moving in the upward direction. It is in the uptrend. That is what they meant by saying the market is making higher highs and higher lows. Okay. So now moving back. So in this condition, they are saying that how can you determine what is going to happen next? So for understanding that, you can ask yourself certain questions, and these questions are as follows. What kind of price action will sustain the buyers believe that they can make more money? So when the trend is going in the higher high direction, what will make more buyers to enter? Because when the more buyers will enter, then only the price will move further ahead, right? So what kind of price action will sustain the buyers believe that they can make more money? So for the consisting buyers, what price action will make them hold their position more for the higher target or higher profit? When are sellers likely to come into the market in force? And when exactly the sellers will come into the force so they can generate the opposite momentum? Where are old buyers likely to take profits? Where are old sellers likely to lose faith in their position and bail out? So the old buyers, as in the one who entered and now their price has moved up, they have already made some money. So when exactly they will decide to take their profits? And when exactly the sellers likely to lose faith their end position and bail out? So sellers, for them to get profit, they have to sell at high, right? So if they sold at high according to their belief, and now the price has already gone up, so that means they are in a losing position. So when exactly they will be in fear, or when exactly they will lose faith in their position and bail out? What would have to happen for buyers to lose faith? When exactly the buyers will lose faith? What will have to happen to draw new buyers into the market? When exactly the new buyers will enter? So these are the kind of question you can ask yourself. You can answer all these questions by identifying certain significant reference points where buyers and or sellers expectation are likely to be raised and where they are likely to be disappointed if they don't get their way. Actually all this work quite nicely in the typical market behavior patterns and price formation with which we are all familiar. So we are going to look at the psychological makeup of some of these typical patterns. However, before we do, I want to cover a few more definitions. Okay, let's cover a few more definitions. So there is a light that is coming on from the behind, right? Now it is better. Hmm. Now, market behavior. All right. So the market behavior can be defined as the collective action of individuals acting in their own self-interest to profit from future price movement while simultaneously creating that moment as an expression of their beliefs about the future. The market behavior, like in which direction the market will move, how can we define it? Market behavior can be defined as the collective action of individuals acting in their own self-interest to profit from the future price movement. So market movement will be decided by the individual's self-interest, you know, and on the basis of they are willing to enter, and price will move in that direction and ultimately they will take profit. So that's their belief. My market behavior is determined by this, while simultaneously creating that moment as an expression of their beliefs about the future. Okay, behavior patterns result from the collective actions of individual traders doing one of three things: initiating position, holding position, and liquidating position, right? So in simple words, initiating position means you enter. Holding position means you are in the position still. Now you are not, selling, or you are not buying more, but you are just holding your position. You have already bought it earlier. Now liquidating means you are getting out of the trade. Okay, so these are the simple things, or the simple terms that I have told you. So initiating position means you are entering, holding position you are still in the trade, and liquidating means you are coming out of the position. All right. Now, moving ahead, what will cause a trader to enter the market? A belief that he can make money, and what the current state of the market offers an opportunity to enter into a trade at a price level that is higher or lower than the price at which it can be liquidated. What will cause a trader to hold a position? A sustained belief that there is a still potential for profit in the trade. What will cause a trader to liquidate a trade? A belief that the market is no longer provide an opportunity to make money. This would mean in a winning trade that the market no longer has the potential to move in a direction that will allow the trader to accumulate additional profits, or that the risk of staying in the trade is too great in relation to the potential for additional profit. In a losing trade, the trader believes that the market no longer has the potential to move in a direction that will allow him to recover his loss, or the trade was a calculated risk in which a predetermined loss level was set in advance. If you look at any price chart, you notice that over a period of time, prices will form patterns in a very symmetrical fashion. These kinds of symmetrical looking price patterns are not an accident. There are visual representation of the struggle between two opposing forces, traders squaring off, so to speak, taking sides and then having to switch sides to liquidate their trades. Okay. Now, what you would be looking for in these charts are significant market reference point. These are determined as anything that causes traders' expectation to be raised about the possibility of something happening. There are points with a large number of traders have taken opposing position. Based on those expectations, they will continue to hold a position in the belief that the expectation will be fulfilled, and most important, they will likely liquidate a position as a result of the expectation being fulfilled. Significant reference point are places where the opposing forces, traders with opposite beliefs about the future, have taken a stand, where they have in their minds prescribed for the market very limited ways for it to behave, and either or situation. The more significant the reference point, the greater the effect traders will have on prices, as the balance of power will shift dramatically between the two opposing forces at these points. These expectations about what the market will do projected into price levels are especially significant because both sides, buyers and sellers, have decided in advance their degree of importance. Where one trader is taking one position, betting the market can't or won't do anything or do something, and the trader taking the opposite side of the trade is betting that it will. So reference points are price level where many traders on one side of the market are very likely to give up their beliefs about the future, whereas the other side will have their beliefs about about the future reinforced. It is where each side expect the market to confirm what they believe to be true. You could say it is a place where the traders' expectation about the future and the future actually meet. This means for one side in their minds that the market will make them winners, their beliefs will be validated. All the traders on the other side, however, will be made losers. There they will feel the market took something away from them and will eventually be disappointed. I want to point out here that the objective observer doesn't care one way or the other. She would just be looking for signs and opportunities. The greater the expectation traders have about something happening, the less tolerance they have for disappointment. On a collective basis, if you have a whole group of traders who expect something to happen and it doesn't, they will have to trade from the opposite direction of their original trade to get out of their position. On the other hand, the winners had their beliefs validated, consequently leaving fewer and fewer traders available to let the losers out of their trades. The losers will have to compete among one another to the limit for the limited supply of traders willing to take the other side of the trade. The side the originally believed would be successful. For example, if buyers are the losers, they will need other traders to buy from them to get out of their position. All this activity will result a great deal of moment in one direction. Balance areas. J. Peter Mayer and Kevin Coy in their book Markets and Market Logic. Okay, this is something important. I'll take a note of it. Maybe this is also I'm going to cover next. Let me just. Hmm. Okay, going back. Chicago Porcupine Press 1987 refers to a value area where they discovered that the majority of trading activity on any given day takes place in a normal bell curve distribution pattern. This is very easy to see day after day when you organize trading activity so that you can see how price corresponds with time. I don't want to get into a lengthy discussion of their methods of organizing market data, which I recommend you learn, other than the distinguish between what they call a value area and what I call a balance area. Stidlmayer and Coy say that most of the trading volume takes place within a specific price range because that range is what the market has established as a fair price representing the value of whatever is being traded. The distinction I want to make is that the majority of traders don't specifically relate to a fair price or value. They relate to comfort. What gives them comfort is doing what everyone else is doing. In a balance area, traders are basically absorbing each other's order or energy, their beliefs about the future expressed in the form of energy. When I say that traders relate to comfort, I mean some degree less of the fear they normally feel. Most of the traders take place in a value or balance area because it is where most of the traders feels the least fear. Somewhere in the middle of the trading range between an established high or low. This is precisely why there are fewer trades outside the value or balance area and why. As Mayer and Coy say, these traders represent the best opportunities to make money, to buy or sell away from value. And that is why these are the scariest trades to make because the trader who can make them in who can make them is all alone. There is no safety in numbers. There are traders who relate to value by giving comparisons between various interrelated contracts and the cash market. There are the professional, commercial, or institutional arbitrage traders who will put on or take off position based on sophisticated mathematical formulas that determine the present value of something as it relates to something else. Otherwise, the majority of traders don't have the slightest concept of value. The more time the market spends at a certain price or in a price range, the more balance, agreement, or comfort there is in the market. Traders are absorbing each other's order, and nobody is willing to bid the price higher or offer the price lower. Eventually, someone will enter the market who doesn't agree with everyone else and believes there is a possibility for the prices to move much higher or lower. This person or group of traders will basically upset the balance with their buying or selling activity. If their activity is forceful enough, it will set off a series of chain reactions, and it as it causes other traders who are either holding position or watching the market for opportunities to confront these new conditions. If the balance is tipped in favor of the for the buyers, for example, it may attract new buyers into the market, creating more buying force and hence more disequilibrium. This may cause the traders who are holding short position to liquidate. To do that, they will need to be buyers, leaving fewer and fewer sellers willing to take the other side of the trades. The buyers wants to get into and the old sellers wants to get out of. These traders will compete among one another for the dwindling supply of sellers, bidding the price higher and higher to make it more attractive for someone to sell. While these traders are in their own little bidding war, they usually lose sight of the fact that the rest of the world is watching what is going on. There would be a trader who is looking to put up on a massive hedge to protect the value of an investment portfolio or crop. He's observing this price action from a completely different perspective than the traders on the floor. The floor traders are just concerned with getting their share and not missing out the opportunity. These rapidly rising or falling prices represent. The hedger, on the other hand, is looking at the price rise as an unexpected gift. The rally could have provided much higher prices than the anticipated for locking in the value of something he already owns. So the commercial traders decides to put on a hedge, and you can assume if one commercial thinks the price is good, others will too. Anyway, if the hedger has an order to perceive to be big enough to stop the rally, he'll give instruction to the floor brokers handling his orders to do scale in selling. The purpose being to get as much of the order sold as possible without ruining the rally. However, it won't take long for the other floor traders to figure out what is going on. They are very aware of which floor brokers fill orders for big commercial and institutional customers. Once they find out someone big is in the market selling into the rally, few, if any, of the floor traders will go against them by continuing to buy. No one wants to get caught at the top. So, as each group of traders find out who is selling, they will all try to reverse their position by selling, and the cycle starts all over again. Watching this happen from the outside of the pit, it would seem that the reversal is instantaneous, but it isn't. It occurs in waves. As the information about who is selling spreads from the source outward, very much like the waves that result from throwing a stone in a pond. This leads me to the observation that few traders have any concept of value. They know that the price movement creates an opportunity to make money, and it can just as easily take the money away if they don't know what they are doing. With the price trades with a certain range for a period of time, traders will become comfortable with that balance area, making it easier for the trader to trade. As price moves out of the balance area, fewer trader will anticipate because of what they perceive as more risk than they are comfortable with. Highs and lows. Probably the most prominent of these significant reference points are previous highs and lows. If prices are moving steadily higher, buyers will begin to anticipate whether or not prices can penetrate the last high, and sellers will be looking for another top. In the mind of the seller, the last top or other tops is the distant past, was a place where the market met enough resistance to stop the rally. In other words, enough traders thought the price was expensive the last time it was there, and they will begin to anticipate whether the same will happen. Both buyers and sellers will have raised expectations about the likelihood of the market doing one of two possible things, making new highs or falling to make new highs. As the market approaches this high, if some of them are willing to bid the price pass it to some significant level, it could make believers out of the other traders who were on these sidelines. If these new traders come into the market as buyer, it will add to the upward momentum, possibly causing old sellers to bail out of their position. This will also add to the upward momentum of price movement. Support and resistance. In a falling market, support is a price level where buyers enter the market or old sellers liquidate their shorts with enough force to keep prices from going any lower. Right. In a rising market, resistance is a price where sellers entered the market or old buyers liquidate their long with enough force to keep prices from going any higher. So resistance is from where the market, start coming down, and support is from where the market will go up. Support and resistance level are significant reference points because many traders recognize support and resistance on charts, believe in their significance. That statement may seem redundant, to some people, but it really illustrates a very important point about the nature of the markets. Traders acting on their belief in future value, all beliefs eventually become self-fulfilling prophecies. If enough traders believe in the significance of support and resistance and demonstrate their belief by making trades at those levels, they are in fact fulfilling their own beliefs about the future. As observers, we know that each side in the perpetual tug of war between buyers and sellers expect one thing to happen. Then we will know who will be the winner, who will be the loser, what they will likely do in each case, and how it will affect the balance between the two forces. For example, if buyers are bidding up a market, causing prices to rise, and all of a sudden many traders are willing to sell for less than the last price, or one trader comes into the market with a big order to sell, causing an immediate price reversal, the price level at which the market stopped is resistance. Now, it really doesn't matter why the balance of forces shifts from buyers to sellers. Everybody will have their own reasons for what caused prices to reverse. All of them will usually be way beyond the simplest and most obvious reason that enough traders were displaying a strong enough conviction in their belief in future value to stop the upward price momentum and create downward price momentum. What is really important about this, however, is that many traders will remember the market reverse at that price level. As a result, the price will then have a degree of significance in their mind of those traders who experience the reversal. This first reversal is a top. What we don't know is whether it will remain a top, how long it will take before it is challenged again, or whether it will ever be challenged again. If the buyers are dominant enough to bid the market back up to the previous high, they will consider the second attempt a test and begin to anticipate whether or not prices can exceed the previous high. The only way that can happen is if these higher prices actually attract additional traders into the market or the buy side because they believe it an opportunity to buy it low related to the future. Flow traders are especially aware of whether or not new traders are being attracted into the market from off the floor and act on this information. For the sake of this example, if the market reversed very strongly the last time prices approached this level, there will be many traders who will think it will probably reverse again. As a result, act they may act on their belief about the low probability of price trading beyond the last high and thereby prevent it from happening. If more traders are willing to act on the belief that it won't in relation to those who act on the belief that price will stop again. Technically, once the market tests a previous high or low and fails to penetrate, you then have a defined support and resistance area. Support and resistance are most easily identified in point and figure charts because they graphically represents price movement in reversal. Once support and resistance are established and identified, it can be very easy to trade by putting your ad orders on either side of the support or resistance lines. For example, if over the last 2 weeks, every time the bonds rally to 95.25, then fall back significantly to some support level like 94.10, what I have just described is a support and resistance zone, commonly referred to as a trading range. The significance of either end of the zone would be determined by how many times price rallied to 95.25 and failed to penetrate, and how many times prices fall to 94.10 and fail to penetrate. Obviously, this the more attempt and failures, the more weight these points will have in the minds of the traders who experience these tests and subsequent failures. For an objective observer with no bias towards any particular direction, trading ranges can be very easy way to make money. As the market approaches 95.25, put in an order to sell somewhere around 95.21. Since we know that the market are not precise, you don't want to put your order exactly the upper end of the range because each time the market makes an attempt to penetrate, there will be many traders who will be anticipating a failure. As a result, they will start selling early and the price may never get to 95.25 for you to get filled. If you had placed your order there, also put an order if in the market to stop and reverse, possibly around 95.31. Each circumstances will be different. In this example, the six ticks that I have given the market to define itself may not be enough. The object would be to put your orders in a place where the highest possibility is that it'll continue in the direction of your trade. If the market trades to 95.31 still may not be enough for all sellers to become disappointed and bail out of their positions. en masses, causing price to rise even further. This trade will future This trade will work if the resistance level has a high degree of significance in the minds of enough traders for them to act and sell against it in relation to those who are willing to buy. Each time the market approaches this area, traders will expect either one of the two possible things that can happen. The markets will penetrate or it will fail again. In any case, the price move, that result will be significant because one side of the market will be disappointed. And if we know that what will validate and disappoint each group, then we can determine how they will likely behave and thereby affect the balance of the market. Since the market can display billions of combinations of behaviors from one point to the next, significant reference points like support and resistance narrow these behaviors down to two likely possibilities. By putting your order on both sides, you can take advantage of this situation regardless of what happens, basically hedging. Support becomes resistance and resistance becomes support. Many traders have read or heard that all support becomes resistance and all resistance becomes support. This bit of market insight is valid for some very sound psychological reason. If resistance has been established at 95.25, it is because there were enough traders who sold at that price to make it resistance. In fact, it would probably be the same group of traders who sold at 95.25 each time the market approached that price. So every time the market rallied up to 95.25 and sold off, it made winners out of all those traders who chose to sell at or near at that price. As a result, 95.25 will take a great deal of significance in the minds of the traders who were successful. Each subsequent time they are successful will only strengthen their belief and faith in the price level. Now the price rallied up to 95.25 again, maybe for the fourth or fifth time. And like the last time, you will have a group of traders who believe in the resistance level and will sell against it. Only this time the buyers are very strong on the way up and continue to buy right on through the resistance level. All the traders who choose to sell at 95.25 are now faced with having to deal with the losing trade. Some will get out with small loss, others will hang on hoping the market will come back. In any case, the market invalidated their beliefs about the future and they are suffering considerably. They had faith in 95.25 and in their minds the market betrayed them. If the market happens to come back to 95.25 after rallying for several days, how do you think the group of traders who sold at 95.25 the last time, the ones who believed there they are betrayed, are going to behave? First, the traders who are hanging on in hopes for the market coming back will bail out as soon as they are close to being made whole. They are so grateful for the getting their money back. There is no way they will stay in that trade regardless of what the possibility are for additional profits. They will have to be buyers to liquidate their sorts and will be all too happy and to end their suffering. The traders who originally cut their losses when the market blew through 95.25 won't consider selling at that price again because of the emotional pain of being wrong the last time they sold at that price. I'm not saying they will in turn be buyers at that level, but they are very likely not to sell. The overall effect this will have on the balance of the market is to take away from the existing pool of available sellers at 95.25 old resistance, thereby causing the balance to be tipped in favor of the buyers. Hence, old resistance becomes support and old support becomes resistance for this same reasons. Okay, it is like few more. Okay, we have already covered it. All right, trends, a series, trends and trend line. Right, we have already covered the support and resistance thing. Shall we take okay, can we pause it for a while? We can, right? Okay, so now we are going to talk about trends and trend lines, right? So trends, a series of higher highs and lower lows or lower highs and lower lows over a period of time work because there aren't enough sellers to absorb the number of buyers competing with each others to get into the market during the period of time. Adding to this buying force will be old sellers at lower levels who finally lose faith and bail out of their position. They will do this in significant numbers when the prices penetrate that they believe to be significant reference point. Keep in mind that trends are a function of time. The next tick up could be defined as a one tick trend. How long will be will the imbalance between buyers and sellers last? In an upward trending market, prices will retrace because buyers are taking profit. This will create some counteracting pressure. But if the trend continues after a normal retracement, it just tells you were still there was you know it just tells you there still aren't enough sellers around to absorb all the buyers with enough left over to create downward momentum. You'll know that you'll know when that has happened when the trending market breaks its normal EBB and flow pattern. That is why market that breaks trend lines have a tendency to keep on going to the direction of the break, because it signals a significant shift in the balance of the forces. After a certain period of time, you can notice how trending markets will develop a certain rhythm and flow, making the price movement looks very symmetrical on a bar chart. You really don't have to know why this is so. You just have to notice that it exists. When this flow is broken, the market trend trading above or below a significant trend line, it is a good indication that the balance of the market forces has shifted. Then ask yourself, what is the likelihood the shift will gain hold and continue trending in the direction of the break? Okay. You don't even have to know the answer of that question. Put in an order at a spot that would confirm the higher probability of a change in the balance. Then wait for the market to define itself. If your order is filled, put a stop where the market shouldn't be to confirm that your trade is still valid. What is a valid trade? You ask. One where the highest possibility for price movement are in the direction of the prevailing force. High retrace really rally to a lower high. Okay, I'll give you an example. No matter how simple a trade this is, it has very sound psychological reason for working. In this example, the market made new highs and sold off. The sell off could be the result of new sellers coming into the market in force, or old buyers selling to their profits, or a combination of both. Prices will continue to drop until enough traders believe the price is cheap and are willing to take the initiative and bid the prices back up. As the price approaches the last previous high, buyers will begin to anticipate whether or not prices can penetrate, and sellers will be looking for another top. In either cases, expectation by both will be raised. If some buyers are willing to bid the price past the previous high to some significant level, it will make beliefs out of others who were on the sideline. If they do come in, it will add to the momentum. Some old sellers will admit to being wrong and will have to buy to get out of their trades, thus adding to the upward momentum. However, that if the market approaches the highs the second time and sellers come back into the market again and enough force to keep the price from exceeding or e- e- equaling the previous high, buyers will start to become disappointed. Where will they really be disappointed? If enough buyers don't come into the market to support the price at the previous level, if price penetrate that low, watch for buyers to bail out on in masses. For them to get out of their position, who is going to buy it from them? If everybody is trying to sell and no one is available to buy, what are prices going to do? Fall like a rock, right? Correct. The reason why a bull market is ready to turn into a bear market when the general public gets involved is because the general public has the least tolerance for risk and consequently needs the most reassurance and confirmation that what they are doing is a sure thing. As a result, they will be the last to be convinced that the rising market represents an opportunity. If a bull market has lasted for any length of time, the general public will feel com- uh, compelled to jump onto the bandwagon, so to speak, because of their perception that everyone else is doing it and making money. They will pick up on any reason that sounds the most rational to justify their participation, when in reality they will know very little about what they are doing. But since everyone else is doing it, how can they go wrong? A continuing bull market requires the continual infusion of new traders, very, very important, who are willing to pay higher and higher prices. The longer a bull market lasts, the greater the number of people who are already participating as buyers, leaving fewer and fewer traders who haven't already bought and fewer traders who are willing to bid the price up. These old buyers obviously want to see the market keep on going up, but they also don't want to get caught holding the bag. If the market stops going up, as their profits accumulate from the higher prices, they start to get nervous about about taking their profits. Important thing, important market behavior. Okay. If you're wondering what I'm doing, I'm just putting this information in my notes and stuff. By the time the general public starts buying on masses, the professional traders knows the end is near. How does the professional traders knows this? Because the professional knows that there is a practical limit to the number of people who will participate to bid the price up. There will come a point where everyone who is likely to be a buyer will have already bought, quite literally leaving no one else to buy. The professional trader would like the market to continue to go up indefinitely, just like all the other buyers. However, he also understands the impracticality of that happening. So he starts taking the profit while there are still some buyers available to sell to when the last buyer has bought. The market has no place to go but down. The public gets stuck because they weren't willing to take the risk when there was still potential for the market to move. For the market to sustain itself, it needs to attract more and more people, as big as this country is, or the world for that matter. There are only so many people who will buy. Eventually, the supply of buyers runs out, and when it does, the market falls like a rock. The professionals have been selling out their position before this happens, but once the supply of buyers runs off, the professional starts to compete among one another for their available supply of buyers, which is dwindling fast. So they offer lower and lower prices to attract someone into the market so they can get out. At some point, instead of the lower prices being attracted to people, it panics them. The public didn't anticipate losing. Their expectations are very high with very little toleration of disappointment. The only reason they got in was because it was a short thing. When the public starts to sell, it starts a stampede. Okay, I'm getting so many answers of my questions about the market in general. Man. Hmm. Again, people will ascribe their actions to some rational reason because nobody wants to be thought of as irrational and panic stricken. The real reason why people panic and the prices fell is simply because the prices didn't keep on going up. Right. Actually, right. So by this, we are coming to the end of this chapter. And yeah, today we learned about some technical terms related to market. So if you are new and you are not very aware of these terms, then I can make a separate video on it and describing all the things. But if you are very like you are already aware of certain things, then it was easily understood, right? It was very easy to get what the author is trying to say over here, how the price action exactly works, and what is happening when the market is coming down, what is happening when the market is going up. Right. So that is a very important thing that we have learned today. And tomorrow we are going to talk about the step to success. So far we have understood about the psychology, how the market works, how the important technical terms work. Now the step of success, like what exactly we are supposed to do as a word itself. Like the chapter is getting started from self-discipline. So right, where exactly we are heading to. So yes, this is about today. As you can see, only the around 18 pages are left for this book. That includes last two chapter, and what we learned today was basically support and resistance, trend line, and these are the technical terms, but we understood how exactly they are working, what is the psyche behind it, what is the psychology behind it. That's what we understood. When the market is going higher high, what exactly the people are doing, what exactly the professionals are doing, what exactly the retail traders are doing, and how it will keep on happening, and why the market falls down all of a sudden, because there is a simple trade that is happening on a micro level. The basic thing that is happening is one is selling, one is buying at the same price, they are getting agreed to it, right? But in FNO it is happening very fast, that you are not getting time to analyze a lot of things at the same time. So that's why there is this fear, there is this a lot of other factors kicks in, and that leads us to the next chapter, that is the steps to success. Understanding whatever we learn today is very easy, but when it comes to implementing part, how can we do that? Why self discipline plays very vital role? Because there is this time factor. Whatever we are learning here, we are learning at our own pace, but in the market it happens very quickly sometimes. So decision making time requires very less time. Like decision making requires very less time in the actual market. And whenever the time is limited, the pressure goes on. And whenever the pressure goes on, if you are self disciplined, if you are very if you are disciplined enough to act, then only you will survive, then only you will make a profit. Otherwise, you'll go to the general mentality of the people, you'll go with the people who are not able to hold their emotions, and ultimately falling into the pit, giving profits to other in one way or another. So yeah, so that was the gist of today's chapter and the crux of what we are going to learn in the next chapter. Thank you so much for listening so far, and I hope all of you understood something about market today. You have learned something today. So yes, thank you so much, universe. Thank you so much, Radharanji. Have fun. Peace out.